Good morning and good evening to all my fellow panelists at Salon and to the audience tuning in. Hoping to have a great discussion today on US, China, and China-related trade and technology issues, particularly trade patterns. The question I wanted to dwell on initially was, are we seeing any differences or shifts in China's post-COVID export basket in terms of export structure? Recent surge of exports. What does it say? Are we seeing that? Well, let me frame my response in these terms. China. I'll keep this brief and keep it so that we can be in a discussion format. That basket has not shifted significantly. First of all, at this point of time, that basket will shift significantly. We still have things like computers, office machinery, semiconductor parts. Those are still primary. Electronic goods are primarily the export from China. But we are beginning to see things like electric batteries creep in. And I would submit to the group that, I mean, we are going to see this in spades going forward, particularly in green goods. Folks have been talking about a second China shock, and they're talking in terms of green goods, particularly lithium-ion batteries, EVs, et cetera, et cetera. So at this point of time, we're not yet seeing it, but I think there is going to be a shift in that basket. Down the line in our discussion, we can come to how China's trade structure itself is changing in terms of, there have been particular eras, or let me just get to it very quickly right away. And so I think it falls into the discussion. I mean, China started out and say when it began its reform and opening up, it created a liberalized environment. Bring your inputs in, set up shop, export out. That was how it was. And China began to become this great kind of dynamic exporter in light manufactured goods. The next stage set in when folks could always bring their inputs in, but the foreign invested enterprises realized that in China itself, we can source locally. We don't need to source internationally because the goods can be produced at a just as good and at a cheaper rate. And then in the 2000s, China became this massive dynamic exporter. Third stage, and I would submit the third stage is somewhat now, where that processing trade, what makes China really a trade superpower is the fact that it's no longer low-cost assembly. It's no longer the world champion in low-cost assembly and export. It's become the world champion in intermediate goods production. And therefore, if you do need to make a good, no matter, even if you want to friend source or outsource, friend source or reshore and cut China out of the loop, the point is, if you're doing it through Vietnam, you are going to be sourcing intermediate inputs from China. And therefore, what has essentially happened in this third phase, when China is becoming both a great trade and investment player, it's not just only about exports. It's also capital is moving out of China and seeking greenfield investments in third countries. We already, in terms of the Belt and Road in developing countries, but we're seeing that also in the EU. But the point I'm getting at this point is that those supply chains have just lengthened. It's not that China's been cut out of the supply chains. It's that just lengthened at this point of time because those Chinese intermediate inputs are still so valuable. But over time, especially with the US and some of the other Western countries trying to proscribe China in particular sectors, things like AI, things like quantum, things like chips, we are going to see where we have a duplication of supply chains. And therefore, at this point of time, we don't see that as yet, even though the US's trade deficit with China is down by 100 billion almost. That's perhaps mostly rooted through elsewhere. And so I would submit at this point of time, we are on the cusp of a new of a new pattern in Chinese trade and its engagement with the world, both in terms of trade and from an investment perspective. But in the data per se, which is always a little backward looking, we don't yet see a monumental shift in terms of a breakdown of the coupling that was there between China and many of the developed economies. It's just that that coupling now has become a little more lengthened through third countries, but we'll have to see how that plays and shapes out in the time going forward. Let me just leave it at that, and let me elicit views from my panelists on this.
Hi, Mr. Gupta. Hi, this is Zhiwei. Maybe just to follow on your comments, I think that's very interesting, and also, for my position, we're looking into this from a sort of a firm level, very closely. I work at as a management company in Hong Kong. That we have offices across Asia. We have office in India as well. We're watching this reallocation of supply chain very closely. It's super interesting. I mean, it's in the past 5-6 years. I mean, I was trained as a trade economist, so looking at this now from an investor perspective, from a firm level perspective, is really fascinating. A lot of things we learn. One to echo your point, one surprise I got over the past 5 years is that supply chains didn't move as fast as I thought. Or put it another way, 5 years ago when I started to look at this, I mean, with the trade war starting in 2018, I thought FDI in India and Mexico would rise much faster, much stronger than we actually observed. We are very bullish on India. We actually set up office there 6 years ago. We're still very bullish, but we didn't really see the massive inflow that happened, used to happen. I mean, happened in China after WTO accession, but it didn't really happen on that scale in India or Mexico. I mean, people talk about it. I mean, there are individual cases. People talk about iPhones now starting to get, the second country to make iPhones right after China is India. Their factories getting set up. But if you look at the aggregate numbers, the FDI numbers on the macro level, it's not that strong. Actually, it didn't really grow that much over the past 5 years in India and in Mexico, surprisingly. I mean, there are individual cases again. And then I talked to, economists based in there in India and Mexico. A lot of the stories actually different from what I expected. There are cases, individual cases, actually turns out to be, FDI turned out to be quite difficult. I mean, there are Chinese companies doing business in India that, got into legal trouble, and now they are actually withdrawing FDI. So the supply chains was actually not working, as reallocation as fast as we thought. So I thought that was one interesting surprise that I found on the ground. But I do, looking forward, going into next year, I think a lot of people in the investment community and in the business community are bracing for more tariff coming from Europe, from the US. So I wonder, going into the next couple of years, the reallocation of supply chain will pick up speed. I think that probably will happen. I mean, you probably saw the Indonesian government actually imposing some tariff on Chinese exports, some products, including footwear and textile. That came as a surprise, right? So because the two countries, I mean, there were emerging markets. I don't think people were anticipating this kind of a trade tariff, trade tension to heat up between these two countries, but it's happening. And Brazil is sending signal to China that they would prefer Chinese companies to set up factories there instead of just selling EVs over there. This kind of scenario. So I do think this reallocation of supply chain in the next couple of years probably will pick up speed, and a lot of the Chinese firms are already doing that. I mean, one major theme in Chinese equity market this year and last year is going overseas. So there are so many examples I can point to, but maybe I'll just leave it there. I mean, I thought that was quite interesting development happening on that front.
Let me just jump and corroborate your point. Yes, that comes to that, the third stage I said, where China is going out with its overseas investments. But your point is a great one. because China is also going up the value chain. And so, yes, while it is the world champion in intermediate goods and will stay that, even within this type of intermediate goods also it sells, it's going to go up the ladder. And there will be other countries which will capture those spaces, perhaps Vietnam. And that's why, I mean, for a country like Vietnam, the important focus area should be not just being the lowest cost assembler, try to be the world champion in intermediate goods inputs, because that's what makes you central to a supply chain. But finally, let me just close out by saying that the point you made was a
Can
good
I
one.
add one point on this?
Okay, let me finish in 15 seconds. I'll finish in 15 seconds.
Oh.
And the point I will make is that, what I was talking about is how the market has kind of embraced or not embraced supply chains. But your point is correct. If you look forward, if you follow the policy dimension, that will impact how these chains kind of get altered going forward. And I think you're correct absolutely in terms of that. The policy element, we've not yet had that discussion, but that is going to shift those chains.
I saw we still have 5 minutes for this question, so I wanted to comment a little bit on. You guys mentioned the Indian and the Vietnam. So on Indian, my former colleague, I was working at U Chicago for 15 years. Raghu was just telling me, Raghu Rajan was telling me he has a new book. Was trying to make a device again to his Modi, the leader. In his mind, that the infrastructure, it seems to be a major block. The all these things that if you wanted to have a important FDI or these supply chain shift towards India, then that part seems to be the bottleneck. And it's a connect to the VNAT. So let me just making one more point on VNAT. In the middle of June, I was helping Tsinghua University to organize some conference to try to understand the most frontier question that most of the policymakers in China would like to know. For instance, that we invited the VNAN and the EV car makers. I will comment on the EV car makers later. But I was so interested or surprised or shocked by hearing the top, the economist at the VNAN was describing their economy. It was basically 20 years lagged if you compare to China. But importantly, that they don't have any ambition to improve on the infrastructure investment. Do not have any. Partly because, surprise, their land market is private, which means that if you want to do the infrastructure investment, they have to buy the land from the private households, and that just makes all these things just almost impossible. So they do not have any plan. As a result, that in some sense we walk away. I mean, like Chinese policymakers, we walk away with a very big relief, saying that this thing could have happened, but maybe 30 years later. That's that's my impression.
Well, I'm not sure.
Yeah. Go ahead. Sorry. No, you please. I have nothing. I have nothing specific to add. Please, you go ahead.
Thank you. We are also looking in Vietnam quite closely as well. Actually, a group of countries that the big question on our mind, again, this is not just, well, from an investor perspective, also from a sort of a research perspective, because I'm super interested in this reallocation of supply chain. Now, which country can take the market share from China in a more meaningful way? Not just, Vietnam to a large extent is a assembler, as Mr. Gupta referred to, right? So there are actually trucks, big group of trucks coming from China to Vietnam and assemble those products, right? So this is super integrated between China and some of the what we call industrial zones or industrial parks in Vietnam over the years. But the value added actually happening, I don't think it's that high. But maybe this is the early stage. Maybe I think a lot of the firms nowadays, they're worried about on the ground is that there will be another round of tariff war targeting Chinese firms that use third countries as production base. re-export to the US and other countries. So they and there could be down the road more push from Vietnam governments, or just like happening in Indonesia government or Indian governments, push for local production. We see more pressure, more signals like that to happen. But when that happens, it's interesting. When that happens, it happens on the sector level. It happens on the sort of a, so it's like you don't see Indonesia pushing China to localize production for everything. They single out 4 products, 4 categories of products. My understanding is that starting from last year, there was an investigation that happened in Indonesia that looked at a much broader set of products. But they eventually decided to zoom in to only 4 groups. And the reason for that is because there's a lot of resistance against those 4 products because they have local production. So because those local producers got squeezed by Chinese exporters, whereas you don't really, there's no EV production. I mean, there's no auto factory in Indonesia or Thailand for that matter. That Chinese EVs going into Thailand to fight with the Japanese guys. Now Thailand doesn't really have their local domestic producers. So it's not just country specific, it's also sector specific, which is quite interesting. Which also tells me that down the road, you could have a lot of trade tensions between China and other countries, but it doesn't necessarily. I mean, U.S.-China trade war is very unique in the sense that it crosses pretty much all the products. But excluding U.S., China's trade tension with all the other countries pretty much are sector specific. That there's no country that going after all Chinese sector. Actually, maybe let me make the one last point is the China supply shock. The way I look at it, the press or a lot of people look at it as a negative shock. It's not. It's actually not. It's to a large extent is a positive shock, particularly for countries without domestic production, right? So if you think about Australia, is not really complaining about Chinese EVs. I mean, they really benefit. Mexico is not complaining. Africa, Latin America, you don't hear. There are a lot of sort of a silent consumers that are benefiting from those cheap products from China, but you don't see that on the press. That's the last point I want to make.
Yeah, one last thing I want to add in this discussion about diversification and shifting of production basis from China is the scale problem. At this moment, there's no other country that can really is in a place to replace China because of the scale. It's so big with the manufacturing base, with skilled workers and decades of accumulated practices and so on and so forth. So each country we mentioned, India, Mexico, Brazil, Vietnam, Indonesia, and so on, will take some depending on their relative comparative advantages at the margin. And so far, what we have seen is not shifting production base from China, but new investment are more diversified than before. So net new investment are going to more countries than just China. Whereas what is in China, stay in China. So that is number one. Number two, I think that, and it is relevant for many emerging market countries trying to use manufacturing as a strategy to develop, is that China is not vacating the low-end production. Everyone say China wants to aspire and to move up the value chain. Yes, they do. So they can now really innovate and produce at the high end of the market, but they don't give up the low end. In fact, because of the real estate decline in the past few years in China, basic things like steel, cement, glass, construction material are in plentiful supply, overcapacity in China, being pushed out and exported to other countries, and on a range of goods and products becoming a competition to the local industry in emerging market countries. So we are talking about trade fiction. China, US, yes, getting worse. China, Europe, yes, getting worse. But also China vis-a-vis many aspiring manufacturing countries in the global south is getting worse as well. I mean, I agree with Mr. Zhang. It's sector by sector, not across the board, but the sector that country happens to be trying to use as the lead sector to develop by government to headwind from Chinese competition.
Sure. Thank you. I think we should go to question 2 now. Yeah.
Oh, okay, good. By the way, I'm a work at Stanford. I used to be at Chicago for 15 years, and my expertise is on finance, and I cover lots of things on the domestic financial markets in China. And why I emphasize domestic, because largely given the closed capital accounts, most of the interesting stuff is on finance side. It's just a very, very domestic, very local. It's the connection to the trade is not a very direct, but obviously the question that the World Salon gave it to me, it's a very good one. It was basically saying, okay, suppose we think about a trade. That's the end point of a discussion. Then the financial markets really play a role in the following sense that the government lead some state-owned banks channeling the financial resources into the export sector. And the question was basically saying, how did it happen? And it's still going on. And is this important? What will happen next? That kind of very natural questions. Now, I wanted to shape the discussion a bit in the sense that that itself is not super, super important in understanding the whole issue. So clearly in the beginning, so I went to college in '95 in Tsinghua. I left the country right before WTO, although that I kept very close connection to my classmates at Tsinghua. All of them become billionaire because of the right time. They have a lot of houses. Yesterday I was in Shanghai. At that time it was super cheap. And what's the interesting story was that they were working in financial industry. By definition, they were not allowed to buy stocks. That's great. They have to buy houses. There's nothing else they can buy. And just, these are the jokes. It's just telling you that the things are very unintentional and then lead to big shift. So during that time, 2005, after WTO, there's a lot of policies really try to make the export as big as possible. So we know the numbers. In 2006, that was the peak. The export plus the import is about 70% of GDP. So it's about a half, and then probably export is bigger than the import. And during that time, there's a lot of supporting policies. One of them is basically asking, let's say, not Tesla, Apple coming to Shenzhen or coming to Henan, Zhengzhou, then you basically don't need to pay taxes for 5 years, that kind of thing. There's a lot of things like that. And think about another example is Huawei. Huawei got a support from CDB. CDB gave them very cheap loans, allow them to go outside to the Western, to the developing countries. All these things is very, very much happening, and it's very important during that time. The export sector really slowed down after the crisis, 2009 crisis. In 2014, that's a big, drop quite a bit. And during that time, the policymakers basically introduced round of stimulus, all these things. So as a result, at this point, the export part is kind of a small. So if you just take a number, which is the export over GDP, last year is about 18% and 19%. It's still significant, as we will see that, during the COVID, the problem is that in China, consumption rarely moved in response to these things. And investment is mainly in government's hand. And if you wanted to adjust, it's easy to get to the bad project. Okay, so export is the most high quality growth. to be honest, from the policymakers' perspective. But unfortunately, it's not the control of their hand. So as a result, that's basically, it's a very important part of their mind, but it's not something that they can easily adjust. Now back to the finance side. Let's making two points. One is that it's interesting that nowadays, given the pressure of the public finance, which is local government, all these things, I saw many interesting reports saying that all these export rebate over the tax, they start to negotiate in the sense that it's the tax, it's the reduction of a subsidy to export firms because they have something to cover. That's very simple. Equation has to be balanced at some point. So that's actually going against the question I was posed, saying, oh, how they still support that. They have to honor something called a budget constraint. Okay, that's the first point. The second point was on the EV, what I learned from the discussion that a month ago. The biggest, most successful subsidy that at this point in their mind is basically subsidizing on the consumer side, and I believe that policy will carry on in that, let's say, next 10 years if China still wants to do this big scale industrial policy. At this point, on the paper, there's no longer subsidy at all because policymakers at Beijing also realize that the size of the EV industry is already too big. That they would like to, in the end, after 5 years, they see top 5, and that's it. And that at right now, almost half a year ago or 1 year ago, they already pulled the plug, saying that we are no longer subsidizing subsidizing in terms of the consumer subsidy. But you might say, oh, these are financial sector. This may be there, but it's still the same. It's very similar. Just the entire country has this pushing for the investment side. So in that sense, that it is misleading to just to say, oh, this is every single thing is pushed out by subsidy. In some senses, the Beijing realizes or really think this is the right way. It's just that we wanted to give a prize to the economy, and the best guy, if you're able, if you're strong, if you're really powerful, with the competition, you might get the prize. And that prize is coming from the public finance side, but I think it's a very healthy way to think about a competition.
I'd like to jump in. Sure. If somebody else wants to say something. Okay, let me jump in out here. And I'll of course leave time for all of this. I mean, I think that's really interesting. And let me try to link this up a little bit more to the trade dimension. As I said, now China is, think back to multiple points or ideas I'm trying to get across out here. In the 1980s, early 1980s, the US went after Japan and said, your currency is undervalued and blah, 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 and Plaza Accord, and Japanese currency had to be appreciated. Now, the positive side effect was that then Japanese firms had to take their manufacturing overseas. They couldn't. It was the high yen was a deterrent to exports from Japan, and so they had to go to Asia. And from that were the beginnings of the great East Asian production networks sponsored by the Japanese. That was the boomerang effect to the Americans, that they were the ones who kind of incentivized that. And we're seeing that process now play out here also, where China is a very dynamic exporter, but it has these high household excess savings, and folks are saying, and plus it's industrial subsidies, and folks are saying this cannot go on. You can't become chew up, eat everybody's manufacturing share. And so China now is going out with its own investment and greenfield investment, and we're seeing that initially with the EU and all. Where the Western countries are bringing pressure on China, and I think it'll be a healthy pressure in the longer term, particularly the EU, because they're pretty wedded to WTO ways, unlike the US. And they have something which they've kind of legislated called the Foreign Subsidies Regulation. And so if you want to produce in the EU, and you want to have gain benefit of many of those procurement contracts, etc., you need to break down as to how your financing came from and what sort of subsidies and etc. that you received. And this has been it's a blunt tool, and some of the wind power manufacturers and others have been hit with it, and they've kind of chosen to opt out of the process of even bidding on those procurement contracts. But China knows, I mean, it needs to be going out. It needs to be manufacturing from third countries. The Japanese did that. The Koreans did that. That's where China is going. It will go both to developing countries like the Vietnams, etc., and Bangladeshs, etc., or in Africa. But it will also go to the developed countries. The EU, it's gone already to Hungary in terms of its EV production and all. And it knows that it needs the next stage in its grand development, external development reform. In 1999 to 2001, it was reform of its trade structure. It's come to a point where it's now trade and investment policy needs to be reformed. And investment policy essentially talks about industrial subsidies and industrial policy back in China, so that essentially China is competing with everybody internationally on what the Euros call a level playing field. So I think this is a healthy development. This is where it's going to go. The US is the kind of the sore kind of the thumb which is kind of sticking out and not participating in this game. It just wants to block China out through its foreign entity of concern rules. But for most of the other countries, OECD countries particularly, they want China to now beginning to adhere to industrial policy rules by OECD standards and have a level playing field. Of course, national security considerations also, then economic security considerations also come to the fore in certain sectors. But I think this is a healthy development. And even at the local government level in China, they're realizing in certain sectors, subsidies, we've seen China's doing so well in EVs and all, and they realize, I mean, some of the subsidies used to be actionable subsidies to which they could be hauled to WTO or to whatever arbitral panel, etc. But there are subsidies you can subsidize, and consumer subsidies and subsidies for infrastructure and subsidies for R&D are perfectly legal and legitimate subsidies. And the transition is happening towards those subsidies, because a lot of the subsidies also can be wasteful, and that's why you're seeing local governments in China now not just dumping money, but trying to play the go via the LP route in terms of providing venture capital so that we can become a little more discriminating in terms of subsidies. But to any Western viewer who is listening today, this is the one last point I would make to them, which I think needs to be internalized, because industrial policy is coming back into vogue in the West. But the one thing they do not, what there isn't enough emphasis on is, yes, there's subsidization in China by local governments, but then, I mean, these firms compete like cats and dogs against each other. I mean, it is a very, very harsh competitive fight. And from that creates these stars who then go abroad and are gaining market share. Well, the problem in the West is that there is not that sort of competition which is thought about. In any case, market players are few, they're dominant, there isn't sufficient competition. And if industrial subsidization and industrial policy is going to succeed in the West, it needs huge more amounts of competition amongst players, with government not picking favorites who could then become world competitive. And I'm not seeing that process playing out in the West. And they will, and I don't think it will help them in the longer term. But of course, for China, it's about transitioning to becoming and operating by advanced economy industrial subsidy means. And that means partly adhering to things like CPTPP. It's ready to do that. It said so in the Comprehensive Agreement on Investment of the Euros. It needs to start really what it says, putting that down into practice. And I think there'll be good things going in. So it's a transitional moment, I think, in international trade and economic policy.
I think I would like to join and amplify the point that Mr. Gupta raised, in the sense that if you look at the so-called subsidization in the electric vehicle sector in China, China has phased out direct subsidy to producers a few years ago. So no tax cut, no subsidized loans, and even consumer subsidization has been phased out. in terms of tax credit or when you buy EV. But now they put in a new system, a credit score, in the sense that each manufacturer EVs, their cars are being monitored compared to the emission standard required by the government. So automobiles and cars EV from a producer exceeding the required emission standard will be given a minus, and automobile from producer emitting less than the standard will be given a bonus, a plus. So at the end of the year, companies that have a minus will have to pay a fine to a pool, and company with a surplus will be paid a bonus out of that pool. So basically, it is budget neutral. The government doesn't have to spend any money, but among the companies, the few dozen companies left from the 400 or so 12 years ago really compete very hard against each other, because those who fail the standard will have to pay, and the payment will go to the winners, emitting less than the standard. So I think it is a very, in my view, a very positive, a very clever way to both encourage competition and to really push company to try to improve their performance. So I think that's something that the West should learn from China.
Interesting. Zhiwei, you want to add, or then we can move to the next?
Oh, I already talked too much early on, so I should.
So you should just we should move on to question 3 so that I keep
That's
time
right, yeah.
on range.
Okay,
that's great.
Great, thank you. So yeah, so on question 3, I guess this is about China's domestic economy, and I would say how this export surge, what's the impact on Chinese economy. Maybe the first point to make is that what China going through now is basically pretty strong export growth and pretty weak domestic demand. Let me summarize in this way. The domestic demand is weak to a large extent because of the property sector going through a downturn, a very protracted downturn. As you probably saw on news, there's a lot of coverage. Property prices still falling. I mean, Shenzhen now. Shenzhen is, I would argue, the most dynamic city in China. Property price down by 20 to 30% by now from its peak. And this is pretty much across the board in Beijing and Shanghai, all the large cities happening, and property prices still falling, and that hurts it has a negative wealth effect on the household and consumption and so on. So that's the background. Now, in this context, I think this strong, sorry, there's a bit of echo. This strong export growth is playing a very important role supporting the economy and helping the government to achieve their growth target of 5% this year. Now, it also gives the government more room, more time to let me think how to put it, not to run a big fiscal, not to run a big stimulus, to put it that way. So in terms of macro policy, I think the export growth played a very important role. China is not running big fiscal deficit. China is not cutting interest rate, despite of U.S. rate is much higher than Chinese rate, and currency under Chinese currency under pressure to depreciate. China is keeping currency stable. Yen already depreciated so much this year. If you look at Chinese currency against the major currencies, except for dollar, Chinese currency depreciated a little bit, but against pretty much all the currencies, actually Chinese currency appreciated. So I think all of this happened because Chinese export is strong. So this is, the one pillar in the economy that's actually working. for the government. So I think it has implication for the overall macro policy. So for us in the investment community, we are carefully looking at exports, and let's see how long it will sustain. I mean, in the first half of the year, export really surprised the investment community. People expected exports to slow, but it didn't happen. In the second half, if export at some point become weaker, it would put more pressure on the government to run, probably to do more to help the economy, either run more fiscal stimulus or cut interest rate, or maybe in the property sector do a little bit more. I think there's really this direct linkage between Chinese export performance and Chinese macro policy in the second half of the year, which has, I think, global implications. Let me just add maybe one last point there is that exchange rate, its currency, is very interesting time that we're, sorry, there's a bit of a echo. I don't know where that come from. Now, maybe very briefly to make the point, because yen depreciated so much, and U.S. interest rate remained very high, there's a lot of pressure on Asian currencies in Asian countries, Thailand as one example, but it's not just that. Many, pretty much all the countries, except for India, because India has higher interest rate than the US. Now, Asia currencies so far has managed to stay stable because renminbi has stayed stable. If renminbi started to depreciate against the dollar, and yen is already at a very weak level and depreciating, in that kind of scenario, it would be very challenging for Asian countries. I think the Asian bloc, a lot of the Asian currencies could depreciate further. Now, even including India, because I think we're looking very closely at India. I think it will be really tricky to look at what's going to happen to Indian rupee if dollar remains strong and renminbi start to depreciate. Which currency will Indian rupee follow? Will they continue to keep the dollar rupee exchange rate stable, or renminbi rupee exchange rate stable? That would be a very interesting question to be tested out, because it's not very clear from RBI what's their currency FX framework at this stage. So maybe let me stop there, and I think in the short term, the export as a major pillar for Chinese economy, it could, in the second half of the year, I mean, people are sort of waiting for to test out how sustainable Chinese export will. Maybe let me stop there.
Yeah, if I can come in to say that for export to stimulate the economy and contribute to growth, it is not the gross export that matters. It is net export. In other words, the manufacturing trade surplus of China has to keep widening every year to have this positive momentum contributing to growing GDP growth. Because if you have the same trade surplus this year compared to last year, it's zero impact on the GDP. So the net export has to be increasing. That means the rest of the world has to accommodate the rising trade surplus that China now relies on to drive its growth. And I don't think that is feasible. China basically run trade surplus vis-a-vis most big countries that they trade with. They have some trade deficit with smaller countries, but US, EU, India, Vietnam, Mexico, Brazil, they run big trade surplus. And I think that we get to the point already where in the US and Europe, they are really very concerned about the rising trade deficit. And when Trump, if he becomes president, the trade deficit of the US has been his key concern during his first term, and will be also a very important concern for him if he comes in for the second term. So I think that the whole export-driven growth strategy that China relies on now, with increasing in the value added and the value chain, I think we'll run into a lot of headwind, a lot of pushback by US, Europe, but increasingly key manufacturing countries among the global south. So I think that is a key question mark that many investors are looking at China from a FDI point of view, asking themselves if this was really sustainable, and to what extent China is prepared to do things to reform the social safety net to encourage more household spending and reduce household savings. And I think that is the question that needs to be resolved.
Could I jump in? I want, that's a great jumping in point. I mean, a departure point to make that exact point and kind of emphasize the trade, where the trade frictions are coming in, because it's the macroeconomic dimension which is also now beginning to creep into trade frictions. You know, there was global financial crisis in 2008, and then China went on this huge invest. At that point of time, China was running a GDP, a trade surplus of almost 10% of GDP. And there was talk, oh, your currency is undervalued. And this had been going on for many years. So China said, okay, post global financial crisis, and when in the Western world, there wasn't that much growth, China would stimulate growth at home through a massive ramp up of investment. And so that investment, there was huge. China had huge savings, still has huge savings, but that investment was kind of captured. Savings was captured in investment, and there was build out of infrastructure, et cetera, et cetera, et cetera. But then by the late 2010s, I mean, China itself realized, I mean, that growth model is not sustainable. I think when Zhiwei said in 2007, it's unsustainable. There were 3 ons, he said, and that China needed to move off that growth model because itself was becoming deflationary to some extent. And then COVID struck, and now China's economy is not in the best shape, but the transition to that growth model, to a more consumption and services-centered growth model that was foreseen or hoped for in 2017, is taking shape, but not taking shape at a pace fast enough. And therefore, at this point of time, there is the fear that the excess savings, household savings, are still very high, but China is moving away from that. Let's throw investment resources, throw money into infrastructure. And so that's creating a deficiency, which is now showing up in the export account through huge amount of manufactured goods being exported abroad. And that's why when Janet Yellen, Treasury Secretary, came to Beijing, it was maybe during the World Bank meetings, IMF World Bank meetings, they kind of struck up, the US and Chinese side decided, I mean, we need to have a platform to discuss macroeconomic issues, because excess Chinese savings is being manifested in global exports, which is creating a lot of pressure on jobs and employment. And in some respects, this has sort of parallels with in the late 1980s, the Strategic Impediments Initiative with Japan, where the talk was, it's not just about trade barriers, which is the reason why the US cannot export much into Japan. It's not to do with trade barriers. Rather, it has to do with developments which are structural to the economy in terms of the oligopolistic structures, the keiretsu structure, the interlocking company structure, which basically blocks US players out from these transactions. And so the US can't export. And so it's behind the barrier issues, behind the border issues we need to talk about. And that is becoming a topic of conversation now, because China's growth model is shifting to more consumption-centered, a little too slowly. Needs to happen faster to cut down on those excess savings. And that is being manifested in these huge export trade surpluses, which frankly, to be honest, are not that huge. I mean, it used to be 10% of GDP. It's now about 2%, 3% of GDP. But still, those numbers are large considering China's size. And so now that conversation is taking shape in terms of macroeconomic imbalances, which are causing these deficits. But the Chinese side the first thing they will say in that context of that framework is, hey, the US at the peak of its economic cycle is running a budget deficit of 5% of GDP. If you don't suck in those sort of consumption, those sort of imports, maybe you won't have such a big trade balance. So, but that is becoming front and center now of the conversation with China, with its main Western partners.
That's right. I think there's this will be a very long discussion on overcapacity and macro imbalance for years to come. But I don't think there will be a easy solution. I don't think in Hong Kong, I don't hear that much of a discussion about this. To be honest, in the policy circle in China, about the overcapacity issue. I think what will happen in the next 12 months is people are bracing for the US election and the tariff war 2.0. And a lot of the firms are working on plans to build factories overseas. EV as one example that I think this outcome of the EU tariff essentially is about Chinese manufacturers setting up factories in Europe and Brazil. I think BYD is already doing that. I think in Indonesia, there will be factories getting built up to circumvent, essentially FDI complementing trade going into the next couple of years. I think people are already bracing for more trade barrier and non-tariff barriers in coming years, and probably inevitably will happen. But I'm as a macroeconomist, I totally see the point that China is too big to rely on exports as a growth pillar. Eventually, one way or another, we'll have to depend more on domestic demand. I think which is just because we are going through this downturn of property sector slowdown, and there's, I guess many people are hoping that this adjustment will end soon, that domestic demand will stabilize. We'll see whether that plays out or not. That's, or more pessimistic guys will say China becoming more like a Japan, and that is a very prolonged transition, right? So we'll see how that goes. So maybe I'm running out of time, so apology for running over time. Let me pass to the next question to Mr. Tran, please.
Well, thank you very much. But what you said is a very good introduction into my my section about foreign direct investment, FDI. So I make several points. Number one, we all see that geopolitical conflict has led to geoeconomic fragmentation of the global economy, which really slows down everything. It slows down growth, slows down trade, slows down FDI in particular. In the first decade of the 2000s, global FDI was about 3.3% of the global GDP. In the past 5 years, it's only 1.3% of global GDP. So huge reduction in global FDI. And therefore, when we talked earlier about people don't see really big increase in FDI going into Mexico, Vietnam, and so on, we have to keep in mind that we have to make adjustment for the fact that FDI globally now is only 1/3 of what it used to be 10 years ago. So that's number one. Number two, in that smaller pool of FDI, there has been a clear bifurcation of FDI flow into geopolitical close countries. So countries close to the US, friendly with the US, viewed as reliable and friendly, receive larger share of FDI, what is left. And the same with China. So that's number two. Number three, in that environment, FDI into China has been declining. If you look at absolute numbers, declining from the peak in 2021, $344 billion inflow FDI, now steadily every year until last year, 163, and first 5 months of this year, about 57 billion. So basically, if that number is analyzed, this year we'll see less than half the absolute amount of FDI that China received in 2021. However, the more interesting point that I want to highlight is that as a percent of GDP, FDI into China has already declined since 1994, when it reached a peak of 6% of GDP, and now less than 1%. So for this year, we but much less than 1% of GDP. The interesting phenomenon that people should really pay more attention going forward is the outbound FDI from China to the rest of the world. So for last year, 147 billion outbound FDI compared to 163 billion inbound FDI. In other words, soon we will see catching up and same amount of FDI flowing in and flowing out. Number four, the outbound FDI has gone to the country that we mentioned earlier, countries that Chinese company want to establish production facilities to circumvent tariffs and to use as a base for export to the rest of the world. Bloomberg Economics last year coined a very nice term, which I use many times. They call connector economies, and they specify 5 countries like Vietnam, Indonesia, India, Mexico, and Poland. Because of their geostrategic location, their geopolitical policies, their manufacturing bases, in the past 5 years, I have been able to attract both from China and US, both increasing trade and increasing FDI inflow. So I think that is where the reconfiguration of global supply chain are happening. The impact of FDI flow to China on Chinese export performance and growth is less and less important. Number one, the absolute amount, less than 1% of GDP, is much smaller than before. So the impact is smaller. But importantly, in the first few decades of the modernization of China, it was FDI companies in China that accounted for the lion's share of export from China. So most of the export until a decade or two ago was really done by US-owned companies or European-owned companies in China. But now the situation is the opposite. Now Chinese-owned companies account for more than 2/3 of Chinese export. And therefore the reduction of FDI into China, in my view, really has less and less impact on export performance and economic growth. But on the other hand, the outbound FDI from China will have more impact on the demand of those countries for Chinese intermediate goods, something that Mr. Gupta raised at the very beginning, from which to assemble and to make final products to re-export to the US and Europe. So I think that the outbound FDI from China will contribute to more growth in trade, particularly Chinese export of intermediate goods to those connected countries. So I think those are the key points that I want to highlight.
You two are from DC. Let me ask you a question, which let's say that this trend happens, and I do see that there's every force pushing the good, great Chinese companies, new forces to open up plants in other developing countries, right? And let's say Mexico, India. Would the U.S. worried about even more, in the sense that they try to find some other ally, all these things?
Answer to your question is yes. In particularly, candidate Trump, he already promised to, if he is elected president again in November, will put tariffs 60% across the board on everybody, 100% on anything.
Everybody, I see. That works.
No, 60% on import from everyone, Europe, Asia, Vietnam, everyone, everybody, 60%.
Yeah.
100% for Chinese, anything Chinese, 100%.
Yeah.
And in
that I got.
Yeah.
Yes.
And in particularly 200% tariffs on Chinese electric vehicles produced in Mexico.
Okay. I do think that if they really want to stop everything flowing to the US, they need a 200%, because there's an easy calculation you could do it.
Well, I mean, right now there's hardly any EV from China being imported to the US at this moment. So all of this 100 to 100% will scare them away. But I use it to show to you that yes, there's a weariness or awareness on the part of politicians in this country, and I think in the European Union as well, in terms of China trying to maneuver and to route tripping or to avoid tariffs that they are putting on Chinese goods by making FDI in countries within the European Union like Hungary, Poland, and so on, and in the US, Mexico, because of the Mexico-Canada-US agreement. So going forward, there would be more, and I agree with the earlier speaker, there will be more attention paid to the local content requirement. In other words, country goods that come into the US in the future, if they want to qualify for low tariffs or no tariffs, have to show that it has the local content above, let's say, 25%, 50% of that country. Otherwise, it will be regarded as a Chinese good. So I think that in this particular case, Vietnam will have a very difficult situation because a lot of final products shipped from Vietnam to US has very low local content from Vietnam and very high content from China. And therefore, if it is below the threshold, those goods from Vietnam will be subject to probably some kind of tariffs in the future. So I think those are the dynamics that I can see from here.
That probably will push more Chinese companies to move factories into Vietnam than manufacturing in China, I suppose. Maybe
Where's our third friend, fourth friend?
We can hear him. That's good enough. That's good.
That is a good stimulant for countries like Vietnam, but it also requires the local country to step up, to train their workers, to provide the facility, to be able to do more and just simply put things together.
Right. That relates to the earlier point that you made. Is about scale, right? So because China is so huge that Vietnam is relatively small, so infrastructure bottleneck. I mean, it's hard. I mean, I talked to some firms in China. They already complain that they go to Vietnam. They want to move factories over there, but the industrial parks are running over capacity. So electricity, all that kind of things. Yeah.
The whole of Vietnam is smaller than the province of Guangdong, so cannot replace China.
So it's probably ASEAN. I mean, that's why Indonesia, or even Philippines nowadays getting into the picture as well. Maybe just one quick comment.
Sure.
It's a funny comment though. In the next couple of years, one thing we may see is that people in developing countries may be driving better cars than people in developed countries.
Already happened.
It's already happening, right? So Mexico, you probably get it.
Age of the automobile fleet in many developing countries is younger than in the US.
That's right. Thailand compared to Japan, Mexico compared to US. So it's a very interesting sort of a deglobalized economy.
Sure. Let me throw out one provocative point out here, which I don't entirely subscribe to, but I think it might be useful in this context of this conversation with regard to Biden and Trump and content requirements. And, universally it's thought like Trump is deranged and he's just going to really mess things up even further. And there are good reasons to believe so on this trade front with so many such tariffs. But I'll submit, let me at least propose that, for China, Biden, in terms of trade, Biden may be the one who is actually a tougher nut to crack, because what Biden is trying to do is strip all Chinese content out from in these EVs and other sectors and all those places, as much content. So even if China wants to produce in Vietnam, we are seeing that in terms of solar, Vietnam and Malaysia, or China wants to produce it through a US FTA partner, Mexico or Morocco, and sell in the US. The US Biden administration wants to knock all the Chinese content out of that product. So it cannot go through a Chinese supply chain. It needs to be the content needs to be derived from an alternative supply chain, does not have Chinese inputs, and is produced outside China. And so that's the way. So that's pretty tough. I mean, there's a stark difference between the US and the EU, where basically China is deemed a foreign entity of concern in all these sectors, and therefore Chinese content itself is fully being discouraged, except in areas like in EVs, EV car batteries, where you just don't have an option and you need to license some of it. But now let me come to Trump, why Trump might actually be a little more favorable in some respects to China. And I mean, might come as a surprise. Trump, the fundamental thing in Trump's head is these items are going to be consumed by Americans. So they must be produced in America. He's a little bit Deng Xiaoping. I don't care if the cat is black or white, whoever produces it, but they need to produce in China, because what got him going in the 1980s was, here he was, the United States guaranteeing the security of Japan while Japan was producing in Japan to the American consumer, making money off the American consumer, and then using that money to buy New York real estate and compete with Trump, and that got him nuts. But even now, the point what he is against is, you want to have the benefit of the American consumer, you need to produce here. And that keeps an opening for Chinese EVs to be produced in the US. Trump has said, I'm going to tear down the Inflation Reduction Act and all those million rules which are there in terms of EVs. It can actually be, if I was
I'm not sure.
Xi Jinping, I would say, you know what? Listen, put this in Trump's ear. Tell him, just like you had that phase 1, phase 2, whatever trade purchases, but which never materialized because COVID broke. Tell him in his whisper into his ear, you know what? I will create this many jobs in EVs in these states or in the American states, which will be then produced there, sold there, and create jobs there. What do you think about that? And I'm telling you, he might bite, which Biden won't.
We have to keep in mind that not only Trump, but the Republican Party really doesn't like Chinese products, and they don't like Chinese FDI. They don't like Chinese ownership.
That's a good point. That's correct. Very correct. True.
In the US. So Trump's approach is different from Biden's. Biden wants to build back better, to build things in America, to redeploy and to develop manufacturing bases again. That's Biden's strategy. Trump's strategy is managed trade, like the trade deal one that he concluded at the end of the last second 2 years of his term. So if China export X billion to the US, they have to import the same X billion from the US. So the trade relationship is zero, so balanced trade. So he will stress on the trade, managed trade approach. And I think managed trade is something that China can deal with. They can agree to sell things to the US, and they'll use that money to buy things from the US, and they will negotiate which kind of things they want to buy. So I think Trump's emphasis will be managing trade rather than attracting FDI and build back like Biden.
Sure.
And I can tell you that a lot of the Chinese firms are pretty scared. I don't think they want to. They want to make a big investment in China. Some of the firms I talk to, they pretty much give up the U.S. market. I mean, even though they are doing very well, that they are pretty much targeting non-U.S. export market going into the next, say, 3 to 5 years.
And the opposition to Chinese FDI is deeper in U.S. society. It's not just from Republican Party, federal government, but at local levels, not only state government, but municipal government. They really object to any projects that they find being built by Chinese company in their community. And many projects have to be aborted in the past few years because of local opposition. So I think that the atmosphere overall here is quite hostile.
It is true. That's absolutely true. Which is not the case as much in, say, other advanced countries like Japan and the EU.
Europe, you are right. In Europe, if China say, I come in, I will build battery in your country, people are happy, but not in the US.
Yeah. In the free discussion phase, let me just take that one, continue on the same point, the point that we were discussing, and in terms of how the Europeans are dealing with the issue vis-a-vis the Americans and the difference. And I think at the end of this will rebound on the US, because everybody else, I'm talking even developed countries, which still have kind of populist sentiments, are finding ways to operate within WTO means or WTO rules and try to hash out their problems, which means it's not about stripping China out of the situation, which is the case where it is with the US. And here's the interesting fact in terms of, we're talking EVs. and right now, I think just yesterday or day before, the provisional tariffs on EVs kicked in on Chinese EVs exported to to Europe. But it's interesting to understand how this same issue, a similar issue, was dealt with 10 years back. At that point of time, there were huge amount of solar panels components flowing into China, and the EU said, like, hey, you're breaking our industry, and this is not okay, and it's subsidized, blah blah blah. But you know what they did thereafter? They negotiated price and volume undertakings, as a result of which China would Chinese producers subscribe to that agreement and would produce at those price and volume undertakings. Anything sold beyond would be tariffed with the provisional tariffs, which were actually larger. The solar tariffs were larger than the ones provisionally imposed on EVs right now. And so what the whole purpose of the Europeans was, we need stable prices so that decision making can happen with regard to business investment in that sector. Oversupply by China was running prices down, making it difficult to make those decisions. So once there's a price and volume undertaking, prices stabilized a bit, and thereafter, most of the Chinese producers were part of that undertaking. That undertaking period was for about five years, after which the undertaking they went back to normal economic exchange on that. And so, in this day and age, when we're hearing, autos, and there's going to be this massive trade war between EU and China, now they put tariffs, and China has done anti-dumping investigations into pork and blah, blah, blah. The fact of the matter is the two sides have already begun negotiating, and my sense is there will be volume and price undertakings, which will kind of manage the pace at which Chinese EVs come into the EU in terms of exports. Simultaneously, there'll be a lot of setting up of shop of Chinese EV firms in the EU, like BYD in Hungary already. And just like, in the 1980s, Japanese firms went out and created their supply chains in East Asia, Chinese firms will be going out and creating the supply chains in these places, in these countries. And I think it's going to be win-win for all. And even the EU's tariffs also are challengeable at, the WTO dispute settlement has been kind of blocked, killed. But what they've done is created a kind of a provisional dispute settlement solution. The 25 WTO countries, member states, it's called the MPI, multi-party interim arbitration arrangement or something like that, which basically operates by WTO dispute settlement rules. So the EU's tariffs are both challengeable, the provisional tariffs are challengeable in that framework, but it might not even come to that, because China and the EU will work out some sort of volume and price undertakings, and then that's the way forward, which is very different from how the US is moving forward on this front. So it's an interesting phase, and interesting to watch for how things evolve.
It is indeed interesting to watch, but I think that in my personal view, WTO is on the way to irrelevance going forward. Basically, because the biggest economy in the world, the US, has lost faith in it. To the US, WTO has more liability than positive feature. Take the solar panel sector. US company pioneered the solar panel 20 years ago. Chinese subsidized their company, come in, cheap price, good quality, wipe out the whole sector within 10 years. The WTO agreement did come eventually, but way too late to save the American solar
sector.
So to the American, it's really no good. And certainly, the key point about the panel of judge to review case, the appellate panel. The key point for the US is that appellate committee in the US point of view interpret WTO agreement well beyond the letters of the rule.
Yeah.
And therefore they themselves impose new commitment, new requirement beyond the intention of the contracting parties. And that is very difficult to fix. So basically, I think that a small group of countries, like you mentioned, the alternative arbitration scheme, they call it plurilateral, not multilateral, but plurilateral, is not functioning very well because it is just a small group of countries. At the end of the day, even the EU has to recognize that the problem challenging them is not local content or not, but the key problem that they really are difficult to overcome is high energy costs after the Russian invasion of Ukraine, and high labor costs because of all of the labor welfare, labor support campaigns. So basically, going forward, anything being produced in EU will be more costly than anything produced in China with or without subsidy.
Yeah.
So
That is just fact of life. So there will be more export from China in because they come in with lower price and Europe cannot compete.
I was in German, so Sourabh, I hope you're right, and this is great. But in Europe, at the Germany, the thing they were talking about is about labor unemployment, because of the right now the current technology is it's at their own heart, the national pride, that kind of issues. But I think that I hope they work out a deal, and eventually people are economists. They will realize that they need to figure out a deal. And the U.S. threat all these things because the U.S. itself is too strong. They can't impose anything, but not other countries.
Yeah, it's true. Actually, you, Professor, I wanted to get your input in terms of, one of the areas. China had a new foreign investment law in 2018, 2019 at that point of time, and then did some liberalization. Some of the liberalizations, part of it has been, one of the key areas has been in the financial sector in terms of the last few years, or not. Yeah,
a lot,
exactly.
Yeah.
Exactly. How is what is the state of foreign investment in the financial sector? Is it managing to create a real change in the way Chinese look at how they manage their household assets? Are they moving away from property and willing to put money in capital assets? And also in terms of, the US has this 401k plans for long-term plans. That's how you create a lot of financial deepening, and then these become big investment players, the pension funds and all those things. Where is that standing in terms of China's financial market development? Because that, I think, has important ramifications on the consumption side and on the structural imbalances within the economy. So where does it stand right now?
At this point, that's extremely small progress. Now, I don't blame, like, it's a coordinated efforts. When Liu He was on the stage, the vice premier, Liu He, he is extremely genuine, and he actually pushed a bunch of parts to make it happen. You see these requirement, registration requirement of the 50%, right? 49, 51.
Exactly.
It's a very
those
symbolic.
JVs,
those things just removed, and you can come in. At this point, when I talk to the people who are the major player in this area, our other Zhang, Mr. Zhang, might have a very first-hand experience on these issues. Almost nothing. And recently, if you follow the big news, that in my area, which all my friends were, most of them are financial industry, this they even ask you to repay, or what's it called, like return some of the past year's compensation. That's just a killer. It's no way, at this particular situation. It's just all the past effort on these kind of things just all evaporated away. I imagine you're gonna need a first, the economic has to come back. Let's say the consumption driven demand pick up. And I believe, in my view, on Chinese recent change on this economy change, is that the real estate crackdown is correct. It's a painful action they have to take. And I actually respect that she is pushing it through. And at some point that you see stabilize. At this point, I feel like it's not a big, it's really not that bad. You know, I could imagine much worse. And the EV picked it up, and hopefully that the people realize that the housing market is this thing, and we need to change. So hopefully consumption pick up. And at that time, then all these investment savings vehicle that can help the progress of the industry that Sourabh was talking about. It takes another 10 years. You know, China has to be grow so fast. We just sometimes you're too impatient. You're way too impatient. This itself require more than 10 years.
This is exactly one of the key areas that I am looking for in the third plenum meeting, which is taking place mid-July, with 10 days from now.
Yes.
Basically, when I was with the IMF, I was involved in advising the Chinese government to really develop, this pillar of the financial system, pension fund, social security, trust fund, mutual funds, and so on. So institutional investor base to support the financial markets. And they agree, and they have done that. And I think that it has made progress, but the key is not quick enough. So they really need to accelerate and bring these institutions up to scale. They have a social security trust fund, but very small in the scale of the economy in China. They have mutual fund industry, but still in its infancy, and so on and so forth. So I think they really need to do these things, which is very much in line with what Xi Jinping has been saying. Common prosperity, and common prosperity is that is the kind of thing that really give people the sense of having financial security in their own age, in their retirement, and give them the sense of participating in the fruits of the economy. So I think that I look forward to see if the third plenum will come out with reaffirmation of this trend.
Sure. I think we've kind of run out of time, and why don't you go a last thought from your end? I'll shoot out a final one, and I think let's wrap it up right there.
This has been a great discussion, and I think thank you very much to Charlie Du, and in the future, I look forward to be able to have a chance to meet up with you and exchange view again in the future. Great discussion.
Exactly feel exactly the same way, Charlie. I think I totally enjoyed the discussion. I hope China can make the transition to a consumption-centered economy. Here's the big prize: the day China becomes the destination for final goods consumption of all the regionally produced goods that is produced by those great value chains in Asia. That might also be the day when the RMB begins to start even displacing the dollar in the Asia Pacific. I mean, it's a big prize to be won. I hope China can do it, but it needs to do much better than what it's doing. But I've enjoyed this discussion totally. Thank you very much. Thank you.
Thank you, Charlie.